It was the heartbeat of the entire crypto market, a steady, relentless, rhythmic pulse that pushed Bitcoin higher, day after day after day for over 40 consecutive sessions. The number flashed green. Inflow, inflow, inflow. It was a force of nature, an unbreakable trend that became the bedrock of investor confidence. The machine, it seemed, was invincible. But then this week, something happened that sent a subtle but unmistakable tremor through the foundations of this bull market. The heartbeat skipped a single, solitary beat. BlackRock's IBIT, the undisputed titan of the spot Bitcoin ETF world, the engine of this entire rally, recorded a day of zero net inflows. The streak was broken. To understand why this is so significant, why a single day of flatlining, not even an outflow, just a zero, could command such attention, we have to rewind the tape. We have to go back to the beginning of this year, to the moment the gates swung open. The approval of the spot Bitcoin ETF was not just another regulatory nod, it was a tectonic shift. It was the moment the bridge was built between the isolated, often misunderstood island of cryptocurrency and the vast trillion-dollar continent of traditional finance. And from the moment that bridge opened, a giant began to march across it. That giant was BlackRock. BlackRock is not a company, it's a gravitational force in the financial universe. With over $10 trillion in assets under management, they are the market. When they speak, global markets listen. When they create a new product, capital follows. And their iShares Bitcoin Trust, IBIT, didn't just enter the market, it devoured it. It quickly became the star of the show, amassing billions of dollars in assets at a pace that was simply staggering. It broke records that had stood for decades in the ETF world. It was, quite simply, the most successful ETF launch in history. And day after day, the data confirmed it. The flow of money was relentless, a one-way bet that created a structural buying pressure underneath Bitcoin that it had never ever experienced before. This created the streak. 40+ days of consecutive inflows. It became a narrative in itself. It wasn't just that people were buying Bitcoin. It was that the most powerful financial institution on earth was their chosen vessel. Every morning, traders would wake up and check the Fidelity flows, the ARK Invest flows, but they were waiting for the BlackRock number. That was the main event. It was the proof that the thesis was correct. Institutional demand was not a myth. It was a measurable, verifiable, unstoppable torrent. This streak became a symbol of validation. It was the data point that silenced the skeptics. It was the engine that pulled the entire market train uphill. And then it stopped. A zero-A flatline. A day where the demand, at least through this single massive channel, was perfectly balanced. Nothing came in, but nothing went out. The market's reaction was fascinating. It wasn't a crash. There was no panic selling. Instead, there was a collective, cautious inhale, a moment of silence. The question hanging in the digital air was simple. What does this mean? In one camp, you have the perma-bulls, the long-term maximalists. They will tell you this is nothing a blip, a statistical inevitability. You cannot maintain a 40-day streak forever. All trends eventually take a breather. They point out, correctly, that a day of zero inflows is not a day of outflows. The money that is inside IBIT is not leaving. It's just not being added to at that specific moment. They argue this is a healthy consolidation. The market needs to digest these monumental gains. It needs to build a new base of support, shake out the weak-handed leverage traders, and prepare for the next leg up. For them, this is a pause, not a reversal. It's the market taking a single day to catch its breath after running a marathon. But in the other camp, you have the skeptics and the realists. They see this as a potential warning sign, a crack in the armor. Their argument is more nuanced. They wonder if this signals that the initial explosive wave of institutional allocation might be reaching its temporary saturation point. The easiest money, the low-hanging fruit from the financial advisors and the dedicated crypto funds, has already been deployed. What comes next? Is the demand from the next wave, the slower-moving, more conservative pension funds and endowments, strong enough to keep the engine roaring at the same pace? This single day of zero for them is a data point that asks a critical question. Was the relentless inflow the new normal, or was it simply the front-loaded effect of a pent-up demand that has now been satisfied? This is where we dive into the real mechanics of the market. The price of Bitcoin, especially in this new ETF-driven era, is a function of constant tension between two forces: the structural, long-term buying from these ETFs, and the daily, often speculative, trading on the open market. For weeks, the ETF buying was so powerful that it overwhelmed any other selling pressure. It was a rising tide that lifted all boats. But if that tide even stabilizes, then the other market forces suddenly become much more influential. We must now watch the other ETFs with hawk-like attention. Did Fidelity also see a drop? Did the smaller ETFs see outflows? The story is no longer just about BlackRock's dominance. It's about the ecosystem's overall health. Is this a BlackRock-specific pause, or is it a sector-wide cooldown? The next few days of data will be more telling than the single zero itself. Furthermore, this event exposes the psychological dependency the market has developed on this single data point. We have become addicted to the green numbers. We've built a narrative of invincibility around a streak. And when that streak breaks, it challenges the entire psychological framework. Confidence in any market is a fragile thing. It's built on stories and data. And when a key piece of data changes, the story needs to be rewritten. This doesn't mean the story's over. It just means the plot has thickened. Let's also consider the macro environment. The Federal Reserve continues to walk a tightrope with interest rates. Inflation remains a concern. Geopolitical tensions are high. In this context, Bitcoin exists not in a vacuum, but as a part of the global risk asset portfolio. It's possible that a single day of zero inflows into IBIT had less to do with Bitcoin itself and more to do with a broader, momentary risk-off sentiment in traditional markets. A large institutional player might have paused a planned allocation due to turbulence in the bond market or an unexpected economic data release. The plumbing of global finance is interconnected in ways that are often invisible to the retail trader. So where do we go from here? The truth is, this is a moment for observation, not for panic or for euphoria. This is the market entering a new phase. The initial explosive launch phase of the ETF era is likely complete. We are now entering the maturation phase. This is where sustainable trends are built. This is where the market proves its resilience. There are two paths forward from here. Path 1, the zero was an anomaly. The inflows resume tomorrow or the next day with the same relentless force. The streak may be broken, but the trend reasserts itself. In this scenario, the market interprets this as a mere pause and charges forward with renewed confidence, viewing the dip as a buying opportunity. Path 2, the inflows become more intermittent. We see a pattern of green days, 0 days, and perhaps even the occasional red day of outflows. This would signal a new, more volatile equilibrium. The price of Bitcoin would then be more susceptible to other factors: mining activity, regulatory news, macroeconomic shifts, and the inherent volatility of the underlying crypto market. The ETF would still be a massive net positive, but it would no longer be an unstoppable, one-way force. It would become a powerful but variable participant in the market ecosystem. Ultimately, the story of BlackRock's broken streak is a story about the growing up of the crypto market. For years, we existed in a silo, driven by our own internal dynamics, but now we are inextricably linked to the vast, complex, and sometimes slow-moving world of institutional finance. With that linkage comes incredible stability and validation, but it also comes with new kinds of data, new dependencies, and new forms of scrutiny. The skipped heartbeat reminds us that no trend is a straight line forever. It reminds us that markets are cyclical and that even the most powerful engines need to idle for a moment. The question now is not whether the engine has stalled, but what gear it will select next. The journey continues, but the road has just become a little more interesting. Watch the flows. They are now, more than ever, the story. The streak is broken, but the revolution is not. We'll be watching to see what chapter this data writes next.